Hello everyone, my name is Michael and the S&P 500 keeps reaching new all-time highs. There are numerous people saying that the stock market is overvalued at the moment and that a major sell-off will be expected to happen. It could be in the next couple of months, before the end of the year, could be next year even. We won't know when or even if there is a sell-off until it happens, but let's say this is true. Okay, there are metrics out there that would also suggest the stock market is overvalued right now. I'm not trying to get into that right now, but basically if you do believe the market is due for a sell-off, there is some compelling evidence for that. If a sell-off is due to occur, is there anything you can do to help protect your capital and curtail the damage? And I say curtail because at the end of the day, even if you do put your capital into what I'm going to mention, you are still going to take a hit if a major sell-off happens. However, the difference is that as opposed to putting your capital into individual securities that may or may not stand the test of time and eventually recover, the assets that I'm going to mention are more likely to recover in the event of a sell-off. I am, of course, talking about ETFs or exchange traded funds. An ETF is a type of investment fund that are traded on brokerage firms and typically contain a basket of securities. These could be stocks, bonds, commodities, precious metals, or a mix. And ETFs are a way to diversify your portfolio, which historically has tended to carry substantially less risk than individual securities. So if a market sell-off does happen, you can lessen the impact by going with ETFs. That doesn't mean your capital will be unscathed, because it probably won't, but it will survive. And if you hold on to these ETFs for the long term, I can't guarantee, but more than likely these ETFs will recover and you will not be left with unrealized capital losses. And I say that because I want to bring up these two examples, Bank of America and Cisco. These two companies experienced drastic drops in their share price through two different periods. For Cisco, it was during the dot-com bubble, and for Bank of America, it was during the housing bubble. But if you invested into the stock of each of these companies at the peak of their bubbles, you would still not be in the positive if you have held to this day. Of course, if you invested after their bubbles, you would, but if you got in at the top when their stock was at their all-time highs, even if you held your position to this day, you would still be at an unrealized loss. That is the type of stuff that we want to avoid, and we can do this with ETFs. I'm going to go over 3 different ETFs. These ETFs are offered by Vanguard, and the key takeaway is that if a market sell-off happens, these funds are likely to recover. It may take a few months or a year, it might take longer, but you will not be left holding the bag, unlike if you invested into Bank of America or Cisco at their all-time highs. The first ETF I want to bring up is the Vanguard S&P 500 ETF with ticker VOO. This ETF tracks the performance of the S&P 500 index, which consists of the 500 largest companies in the United States. Investing into this ETF is hands-off by nature. When a company enters the S&P 500, the portfolio managers take care of it on the back end, and you don't have to do anything. And with the S&P 500, there has never been a year where it has averaged a negative annual return, meaning that even in the worst years for the stock market, like the dot-com and housing bubbles, the index was still positive by the end of the year, which can't be said for certain individual stocks. So even when things start getting bad, this ETF is likely to survive in the long term. This ETF has an expense ratio of 0.03%. So for every $10,000 invested into this ETF, $3 would be deducted or priced in, which is a very small amount. And at this moment, the top 10 holdings in this ETF are in order: Apple, Microsoft, Amazon, Facebook, Alphabet, Berkshire Hathaway, Tesla, Nvidia, and lastly, JP Morgan Chase. So the most significant contributions to this ETF will be originating mostly from the technology sector. which again is a reflection of the current S&P 500. For the last 10 years, this ETF has averaged an annual return of 14.8%. So it does demonstrate that positive returns are possible in the long term, even in the most of turbulent times. The next ETF I want to bring up is the Vanguard Total Stock Market ETF with ticker VTI. VTI does have some comparable characteristics to VOO, but there are a few fundamental differences. VOO represents the S&P 500 index, but VTI represents the entire US stock market. So VTI does include the same holdings as VOO, but beyond the S&P 500 index, this ETF includes small, mid, and large capitalization companies from many different sectors and industries. This ETF currently has over 3,900 holdings, so this is almost 8 times as diversified as VOO. This does have the same expense ratio as VOO, so 0.03%. So for every $10,000 invested in this ETF, $3 will be deducted or priced in. The top 10 holdings for this ETF are also the same as the top 10 holdings for VOO. The difference being that they comprise a smaller percentage of the total portfolio for this ETF. The technology sector still comprises the largest sector for this ETF, so keep that in mind. Over a 10-year period, this ETF has averaged an annual return of 14.7%. So just like VOO, having that long-term exposure is key to ensuring that you do not end up with unrealized capital losses. The last ETF I want to mention is the Vanguard Growth ETF with ticker VUG. This is the most different from the other ETFs I mentioned, and it's very different for a few reasons. The index for VOO and VTI are obvious: S&P 500 and total stock market. The Vanguard Growth ETF includes companies that are primed for substantial growth. So, in a bull market, this ETF performs very well. This ETF does have less holdings than both VOO and VTI. And at this moment, there are actually 290 holdings. The top 10 holdings in this ETF are similar to those in VOO, but there are a few differences. The top 10 holdings in VUG in order are currently Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Nvidia, Visa, and lastly, PayPal. Although this ETF does have substantially less holdings than the prior ETFs, these companies like Apple, like Microsoft, Amazon, Visa, they are all likely to survive market sell-offs and eventually recover. This ETF technically does have a higher expense ratio than VOO and VTI, but the difference is almost negligible. The expense ratio for VUG is currently 0.04%. So for every $10,000 invested, $4 would be deducted or priced in. Over a 10-year period, this ETF has averaged an annual return of 17.47%. So this has performed better than VOO and VTI. But more importantly, it has survived market sell-offs over the long term. And I keep saying that because that is the crucial element: time in the market, especially when it comes to index funds. Index funds have shown to be a very effective asset to ensuring that you do not end up with unrealized capital losses. Those are the 3 ETFs I wanted to bring up. Let me know in the comments if you are invested into these 3 ETFs. Are these ETFs something you would want to put capital in to safeguard it? Or do you think there are alternative assets that would achieve similar results as these ETFs? That is it for this video, everyone. Thank you so much for watching.